difficulties, we're finally here with our. Is this the first live that we're going to be doing that's actually going to make it on the podcast?
It should be, yeah, as long
Okay,
as your
cool.
internet doesn't mess
Yeah,
up this time around.
yeah. So yeah, God willing, this will be also a podcast episode. But uh, Daniel Foch joined here by Simon Belanger, talking about what are we talking about today?
I think we'll talk about the acquisition. I think you've talked about on your podcast, the Canadian real estate
Yeah,
investor. So, Real to acquire Remax. Obviously, Bank of Canada rate decision. Talk a little bit about the Fed as well, and then probably touch a little bit on the new sovereign wealth fund or the
yeah,
Canada Strong Fund or anything else too. If we get some questions, happy to
yeah.
approach those two.
Yeah, I feel like there's a lot of news, right? Like we got the sovereign wealth fund thing going on. We've
Mm.
got, Enbridge pipeline extension, which I think we covered a little bit. We've got, it sounds like Keystone XL is back on the table. So, I feel like there's a lot of news in Canada. It's nice to see some meaningful efforts to diversify our economy. I hope that they are actually going to be delivered on, I suppose. And I think that that's people's like natural inclination is to not necessarily trust, announcements that come from the red team. But let's see. I mean, they've the as they've called it the newly rebranded new Liberal government has been delivering reasonably well on some of the things that they've promised. Not so reasonably well on other stuff. So, where do we want to start? Do we want to start with the real Remax thing?
Yeah, let's do it. So I can go over the deal for those who are
Yeah.
listening, because this podcast will be available on the Canadian Investor podcast feed. So you'll see it's going to be a different podcast cover with Dan's younger face on the podcast cover and myself as well. So we didn't talk about it on the podcast. The deal values Remax at an enterprise value of around 880 million. For those not familiar, enterprise value is just market cap, and then you add in the whatever debt they're taking on. So that would be valuing the current deal. It's valuing Remax at around 7 times EBITDA. Once synergies have been achieved, I've seen that with a few transactions recently where they kind of value it, but they're like, oh, it's actually lower. It's a better deal if you factor in synergies. I'm always a little bit skeptical when it comes to that because those tend to be easier said than done. There's been the transaction values the shares of Remax at around 13.80, and you were asking me, and I'll touch on that, why the shares are actually trading for less. I'll just pull it up right now. I think they're trading around $11 per share,
Hmm.
if I remember correctly when I checked a bit earlier today. So yeah, 11.01, so almost smack on $11 per share. So shareholders will be able to choose between 13.80 in cash or 5.15 shares of the new entity, Real Remax Group. Now, there's a caveat to that, and that's the reason why the share prices are actually much lower than 13.80, because Remax shareholders will actually receive between 60 and 80 million in cash from the transaction. So you can just look at the total value of the transaction, what the market cap is currently for Remax, which I think it's in the 400 million, something like that, maybe a bit more, the market cap right now. So there's a little discrepancy between that 80 million and the 400 million. So the remainder of that would be with new shares of the new entity. So what's going to happen is, even if a lot of shareholders end up opting for the cash, well, it's going to be prorated. So they'll get a little bit of cash and shares. So essentially what you're seeing right now is the share price of Remax kind of reflecting what the real share price is. And you have real stock that took a 20% haircut
Yeah.
or so since it's been announced. So I'll just share my screen here. I do have this for people to see. So you can see here. So this is just the last month. It's looking at the drawdown. So essentially the
Hmm.
peak in the last month, how much it's down. You can see the big drop here. So let's just say it's down about 20% or so since it's been announced. So the Remax shares are essentially reflecting that, because so much of the deal will be tied to real shares or Real Remax, the new entity, whatever it's going to be called. So it's going to be
Yeah.
tied to that. And the reason it dropped so much is also part of that deal, because it's capped at 80 million in cash. So how are they going to get all the other shares? There's going to be a whole lot of dilution. So
Right.
what you're seeing in terms of the price is the market factoring in a whole lot of dilution that will happen for existing real shareholders. So that's in a nutshell why it may look like you could arbitrage it, but at the end of the day, it might not really be an arbitrage. It's
Yeah.
probably just a more reflection where the shares are trading right now.
Is there anything like, are the pricing dynamics that you're seeing play out, is this purely a function of the valuations of the two entities relative to like the deal terms, like the basically 5.1 shares of real for or 5.1 shares of real for every share of Remax or whatever? Or is it like, is the market telling us anything about like evaluation and how it feels about the real estate market? And my like first pass on like trying to interpret it was like that the market was saying that maybe like neither business, like it could be a great deal for both businesses objectively, like all of their realtors might benefit. Real makes technology, Remax needs technology, Remax has lots of agents, Real needs lots of agents, but the market's, I thought, was sort of communicating that maybe there's not a lot of growth left in this industry for either party and they might not benefit that much from either. Is there any like signals on like the
Yeah,
way the future
I know what
looking
you're
basis,
saying. I
or?
think my interpretation would be that the market right now is saying short term, we just see a whole lot of dilution
Right.
and probably not enough value to make up for that dilution. That's essentially what I think the market is saying. Long term, you may be completely right. It might be actually be a great deal for shareholders,
Mm-hmm.
but short term, I think what the market is seeing is basically like, look, are you blind? Do you see what's happening with the real estate market in North America? And I know some of these have more than just North American exposure, but I think the market is just saying, yeah, it's not looking good for a few years. I think they're just, I mean, if you're looking here, I pulled up, I got some of the charts here. So Remax, and you're seeing, okay.
But it's more
So
like pricing and deal signals than like it
yeah, I
trying
think it's
to
more
indicate.
pricing the deal, and it's essentially the market just saying, okay, like the deal is dilutive. There might be some benefits to both businesses down the line, but I don't think they're near term and they're not making up for the amount of dilution that they're seeing.
Yeah.
Yeah, because if you see, and I know they're different business models, Remax and Real, you know them better than I do, but I
Mm-hmm.
think Remax is pretty telling. So for people looking on the live stream right now, you'll see that revenues essentially peaked at the end of 20 or in 2021, and it's been declining ever since. Profits are been up and down a little bit. The profits are in green here, so they saw a loss back in 2023. They're generating free cash flow, but again, free cash flow has been pretty bumpy. So you saw a nice run up till the peak of the pandemic, and ever since the business has been struggling a little bit. I mean, it's still profitable, but I think when you look at it from the market, it's to me, it's pretty obvious that it's just look, there might be some benefits, but in the short term, it's heavily dilutive for shareholders, and we don't know exactly when the new entity will benefit from that, or when it will actually offset the dilution. Is probably a better way to put it.
Right. Okay. Makes a lot of sense. I'm glad I asked you because I like had my own kind of like thoughts on it, but I obviously don't know stocks nearly as well as I know real estate. I'm the first person to admit that. So,
Yeah, I mean,
um,
usually too, and what we had talked about is oftentimes you'll see some arbitrage opportunities, especially if the market is saying, okay, well, we're not sure if this deal is going to go through or not. So whether it's financing requirements or whether it's regulatory approval, that the market is not 100% sure whether it will go through or not. But in this case, from what I've seen, it seems like both should be fine. It sounds like they have financing to close the deal. And from regulatory perspective, you know that better than I do, but from what I saw, it shouldn't be too much of an issue.
yeah, yeah. Okay. Good to know. I guess then general thoughts on like M&A activity. I know like in recession era, you kind of do see like a lot of mergers and acquisitions, businesses trying to like, make more strategic moves, protect margins, et cetera. Real estate industry has obviously been pretty clearly in a recession for the last several years, like declining sales volume, declining prices, et cetera. But Is this the kind of thing that like does this signal anything to you about the market? Do you think that M&A is more of a bear market than a bull market activity?
Yes and no. I mean, you can look at past, if you think of boom and bust industries, whether it's oil and gas or even gold, or precious metals. I think a lot of the time you'll actually see a lot of M&A happen when there's a bit of a bull market. So you have some larger entities buying up some smaller ones. But in the case of bear market, you can also see some for different reasons, right? You have some smaller players that are just struggling, and then the bigger players are coming in a bit more as a lifeline and are able to get a better deal on those assets because they're trading at a discount because it is a bear market.
Right. Yeah. Okay.
If you have smart management, you do buy in bear markets because that's when you have the best deals.
Mm-hmm.
But again, it could take a few years until it materializes. Whether compare that to buying in a bull market where you're paying oftentimes a premium, you're bidding against multiple players for the same assets. So that's kind of the way to see it.
Makes sense. Okay. Awesome. Then I guess, do you want to move on to a couple of the other exciting things? Sovereign Wealth Fund. I mean, I know we're hearing talk
Mm-hmm.
of privatization of airports, Bank of Canada announcement. What do you want to jump into first here?
Yeah, I haven't looked too much on the privatization. I saw the headlines for the airports.
Yeah.
So maybe you can lead a little bit for that. I mean, for the Canada Strong Fund or Canada Sovereign Wealth Fund, I had time to think a little bit about it. We did a segment on Thursday on the podcast. Really, for me, without rehashing it, because I'm sure people listening have heard a whole lot about it. Obviously, there's the initial contribution of 25 billion. The way I see it, essentially, the government of Canada is investing on margin. And they're hoping that they'll get returns that are above their borrowing costs. So it's pretty simple. They'll have to issue debt. I mean, we're seeing some massive deficits. So whether they issue it at 3.5, 4%, whatever rate they get, then they're hoping that their returns will deliver market returns, which is kind of funny because this is where I think this is a real head scratcher for me because you're
Mm-hmm.
looking to invest in strategic Canadian projects, but then deliver market rate returns. I
Right.
guarantee you at some point they'll have to choose between the two.
Or well, like when you say market rate, like what are we saying? Like we're not seeing
They
SPX or
didn't
like
specify. So
right.
are they talking about the TSX here? Are they talking about, I guess it'll be mostly equities. So yeah, they'll probably be comparing that to the TSX. Or are they going to turn around and try to compare that to private equity returns? Like, I'm not quite sure. It's very
Yeah.
vague. But at some point, you have to decide, right? Like, are are you putting a priority over certain things? Is your priority that the government invests in projects that are good for national security, maximum economic growth, or maybe you want to save jobs, so you make investments like that, which they say they may not provide the best returns if that's the goal. But
Right.
we really don't know, right? The governments may have some incentive. I know they talked about arm's length, creating a crown corporation for that, getting support from BDC, EDC, a bunch of different crown corporation as well. But the reality is, even it has an independent board and CEO, it's not truly independent
Mm-hmm.
because at the end of the day, the shareholder is the federal government. And if they have a project that is dear to their heart, even though the corporation does not necessarily see it as the best project, they'll essentially get directive from the federal government to make it work. So there's definitely going to be some incentive at times coming from politicians. That's something to keep in mind, and especially if this fund goes beyond the current Liberal government. So whether the Conservative come into power, then people are quick to jump at the Liberals, but you always have to think beyond the current term, right? What could happen? And the Conservatives could have much different priorities and keep this fund open and some of the investments and then make some new one. But then you also get into the issue in terms of returns, especially because there's a retail component to it, which they did not provide a whole lot of detail. But a lot of these investments will be illiquid. It could take years until we know the actual returns they provided. The government could take some losses. They could make some massive gains too. They could be taking outsized risks here because they're prioritizing certain sectors that are important in their view to the Canadian economy. It also could prioritize certain sectors at the detriment of others. We've seen the Liberals do that in their 10 years or so, where they prioritize green renewable energy at the detriment of other sector like traditional energy or conventional energy. So there are all these questions that come into mind. Of course, the risk of corruption, mismanagement, inefficiencies, misappropriation. These are all risks that could happen when you have something that's politically driven. And of course, how are they going to deal with potentially investing alongside or into firms that have clear ties to politicians? And the one that comes to mind, you can probably tell me which one it is. I know you've mentioned it, but Brookfield, right? So,
Yeah. It is funny. Like I know. I mean, it's like, did we discuss this? I think like we've only really discussed this privately. Like how
yeah,
like I generally just think politics is kind of dumb because it's like, and it's just designed to like turn people against one another and convince us that we're all divided when we're actually probably far more united at the median than we're being told. So I'll caveat with that as I get into this discussion because I'm going to offend both sides equally. Equal opportunity.
it's okay
guy.
if you offend both sides equally. You're in a good space.
Yeah. So it's interesting, right? Like the right had no problem with I don't know, is crony capitalism the right word? Like is that what you would call this? Or like where you kind of like cronyism doesn't imply it's illegal, right? It's just like your homies, like your buddies who
I
are
would
your
probably call this more. I think it's Michael Everett that has a really good term. It's called statecraft.
Okay.
He calls it. So that's that would be part of it, where the well-being of the state is kind of takes precedent over everything else, and I think that's where it's heading. Yeah.
But so you've got like special interests, right? And there we have two very clear comps on how like different types of the voting populace, at least in Canada, felt about this phenomena. And it seems like, you know, they are willing to turn a blind eye if it's the right, as an example, when it's Trump, if it's going to get their candidate elected. But now it's an issue, and again, in Canada, it doesn't really matter because Canadians couldn't vote for Trump. But like, you know, they again didn't have a huge issue with it in that period of time. I don't think it didn't seem. Seems to be maybe progressing a bit more towards like, hey, maybe some of this stuff isn't like what we're cool with. But now they're like huge anti special interests or whatever you would call it. Now that it's Carney in Canada, and you know, vice versa, the left had a huge issue with it during the Trump campaign and had very little issue with it during the Carney campaign. And again, it's just sort of like favoritism around like, hey, I'm willing to bend my morals and exercise this clear cognitive dissonance because it suits like, you know, my political agenda. And so what it kind of tells me is that like most people actually don't really care, to be honest with you. Like I think people have sort of just accepted that politicians of whatever shape and size are going to do things like this, and it's maybe not necessarily a horrible thing if it can advance. Like I don't know, like I think about like the Dawkins like selfish gene, or just like if you look at like any literature on like selfishness or greed and how it can actually like perpetuate a society, and people pursuing their individual interests. And so it kind of just fascinates me as like a thought experiment around like, do we really care if like it's a Brookfield thing, if it ends up getting the, and maybe throw out that example to, so as to, like to not inflame people. Do you care if, you know, if things are getting accomplished in the US or in Canada as a result of this, and the voting populace does benefit, and some other people benefit as well. Like, I don't know. It seems like voters don't really care that much, right?
Yeah. And I mean, at the end of the day, I think people will accept a whole lot if they see results, right? So if they see the benefits behind it. And I think one thing that's really ironic about all this, because obviously Trump is not very popular right now in Canada. He's being used for to blame for a lot of our problems, even though they started well before he took power. And I'm not trying to be saying Trump is right or anything like that, but the reality is what they're doing right here is kind of a playbook of the Trump administration. And
Yeah.
people might not want to admit it, but since Trump took office back in 2025, they took a stake in Intel and MP Materials,
Yeah.
Lithium Americas, Trilogy Metals, and US Steel, all industries that the US government sees as strategic.
Hmm.
And this will likely look very similar to that. I
Right.
don't know for sure,
That's
but
a
it's
really good
kind of
point.
ironic that it's kind of the
That's what I'm
playbook.
saying.
Yeah,
Like
yeah.
I think it was ironic like before like you even highlighted that, which I hadn't really observed.
Mhm.
So that like that makes it even more like just makes it more like of a funny thing to evaluate from my perspective. Um, so then, like, are you confident that in either case, like in the U.S. is obviously an easier market to generate returns in. Who knows whether or not those are real returns or if it's just because they're better at printing money because they have the global reserve currency.
Mm.
But
You have the golden press. Yeah.
yeah, do you think that either of these instances are going to deliver returns? I mean, if I go back to like the GFC, like that, a lot of those bailouts and like bond systems were actually really good revenue generators for the U.S. government coming out of the recession, right?
Yeah, I mean, they could end up providing good returns. I mean, Trump, I think, was tweeting like that the U.S. government has made what, like 3-4 billion now on its Intel stake.
Yeah.
He was out or Truthing on Truth Social not a couple days ago because it's been on absolute tear. But I guess I mean, they could still generate positive or very good returns. But the problem is, I think it's false to think that it just there's these two conflicting mandates, right? So at
Yeah.
some point, I think the national interest mandate, I'll just call it as that, will take precedent over the returns. And
Right.
I think that's where it's not dangerous, but for retail investors that want to support
Right.
this fund and use it, I think it's fine. If you want to invest in those kind of projects alongside the government, that's completely fine. It's your money, you do what you want. But don't expect massive returns. If you do
Yeah.
get good returns, that's great. But realize that if push comes to shove, the first mandate will take over the other one. I have no, like,
Right.
that is 100% sure for me. And if
Yeah.
the government sees it as good business to almost provide an equity investment into a company because they're just losing a whole lot of jobs in Canada and not necessarily because it's really strategic from a national standpoint, they will probably go ahead and do it. And that, I would say, has a higher likelihood of not being a very good investment. And this could just be one of several, but I think that's always a risk that you'll see is where the politics kind of kick in and then the true spirit of the fund starts shifting a little bit.
So, how do you expect this to play out then? And when you're saying the true spirit of the fund, like in this context, you're talking more about Canada than the U.S., I would imagine, because there's no like formal fund. It's more like they're taking investments in individual companies, right?
That's what it sounds like. Yeah,
Yeah.
from what the page and a half that they had in the on it in the spring economic hub. I mean, they did say they'll have more information on it.
Yeah. Um, yeah. Okay. Interesting. And then, I mean, I guess like it's obvious that at least like I think we kind of acknowledged in the last live that I thought it was funny like Trump can't help like trying to do real estate deals like Greenland and like the 51st state and like I know that's like obviously an insensitive way to like make
Yeah,
a joke out of it because it's like not it is kind of like interesting language to come from the president of the United States, but even with the stuff he was saying about like Israel Gaza and like with the tweets of like the like beachfront plan and like it's just like such a like real estate guy, like real estate gone wild, right? But then you look at like Carney, and it's like, well, I mean, being an investment banker and a central banker, and then at Brookfield, it's like he also can't help. Like, they just want to like let their skill set kind of creep into public office, right?
mm,
And it's like, okay, well, now we're going to do a bunch of infrastructure projects. Obviously, he has a very deep network and people who are connected and people who stand to benefit as a result of that. Um, so setting aside like the fact that there's clear conflict of interest that people are expressing concern about on social media. I'm not necessarily one of them. I think I've made my position clear that like I think if it
yeah,
can make people money and serve the public interest, like I just see that as like the like capitalism and the economy effectively like rewarding somebody for creating that that social benefit. But which again, like that's more of a meditation on like the structure of markets and capitalism than anything else. But do we think that these connections and special interests and conflicts of interest and whatever make it more likely that he does a good job at getting infrastructure built and like pipelines and roads and hospitals and whatever, right? Like, what do you think? Like, do you think that there's a now that we're moving a lot of at least on paper and sort of in promise, moving a lot of capital from OPEX layoffs of public servants to CapEx, even though we're hiring just as many people, but it's just on the CapEx because they're projects, right? Do we think it's going to deliver results, project results, not returns? Let's set aside the returns for now.
Yeah, I mean that's the hope, right? That's really the hope, and I think one of the benefit that is like I don't want to be just critical or not critical. I think we're being pretty
Or like
fair
cynical.
on this.
Yeah, I feel like
Yeah,
we are.
I
Yeah.
think we're fair. I think the one benefit that I think it is, and I've talked about that on our Thursday release, is just at the end of the day, there are some projects that the government will probably have to get involved in if they want the project to go ahead. And I gave the example, like let's say they want a pipeline from Alberta all the way to the east to happen. Like I'm sure there's going to be private businesses that will be interested, but it may be a project that there will need to be some kind of government involvement or guarantee, or yeah, maybe the government takes a stake in the project just to show, look, we're on board with this project. We're supporting it. We're putting money where our mouth is. So I think from that perspective, I think it could be a good thing as long as it's done transparently and pretty efficient. And there are some actual results. And I don't know how exactly they'll be quantifying the results because clearly there's the whole return aspect of it. That's one part. But of course, the first mandate will be to, help the Canadian economy, grow the infrastructure, go and support important projects. Like, how do you measure that level of success? And that's the part that's a bit more difficult to measure.
Yeah. Yeah, I guess you're right, and like that, and I guess there's also like a skew on their like ability to create a return and such that like they can always pump like more public dollars or like print, not maybe not print, but like borrow more
Asset
money. Like,
optimization, I believe,
yeah,
is the word you're
yeah,
looking for. Yeah.
yeah, like because they can just keep like yeah. So is there any issues with that? Like kind of I don't know, like overstating or understating returns or benefits or whatever. Like,
I mean, he worked at Brookfield, right? So they have all different kind of models to show that their private equity assets are doing well, or private credit. I'm not taking a jab at Brookfield, but Brookfield is notoriously opaque as a
yeah,
business, and they rely a whole lot on models, and sometimes you have to take their word for it. So I think there's going to have to be a trust element in all of that, but there's also going to be some projects that they are going to invest in that will be multi-year, potentially take as long as a decade. So it's, to me, it actually feels a little bit like private equity in terms of you probably won't see returns for a lot of these investments for several years, if not decades plus. And then whether it's market beating or equal to the market, then that remains to be seen. But that's the way I see it. I'm kind of neutral on it. I'll be honest. There's definitely
mm-hmm.
some. I have some reservations on a whole lot of things, but I mean, we'll have to see. And at the end of the day, the U.S. is already doing something similar. They have tons
Mm-hmm.
of debt. Of course, they're the reserve currency. So a lot of people being critical. I mean, if you're critical of the Canadian government doing this, you should always also be critical of the U.S. government. And I'm sure there are governments around the world that are doing something similar. I know it's not a typical sovereign wealth fund where they actually have surpluses and then they reinvest those, but they're essentially doing what other governments are already doing.
Yeah, yeah. So then the comparison that like people make, like I've always felt like a sovereign wealth fund could be something good for Canada, um, provided it was like coming from a position of strength, right? But like I think the easy like comps that you would kind of lean on would be Norway. Is it Norway? Sweden or Norway? Norway
Norway. Yeah.
and I guess Saudi Arabia
UAE
as well.
has
Yeah,
one.
or
Yeah.
UAE. Yeah,
UAE
So,
is one. I
but
think
these are,
Singapore too. Yeah.
but their sovereign states have far less debt, I think, right? Like they would have been launching these things from a position of much lower deficit. Like you're not borrowing to create it, to my understanding. Is that the correct
Norway,
read?
they're not. UAE, I don't believe either. I'm not quite sure when it comes to Singapore. I know China does have, I think, funds that are a bit like that, but China's a bit in a different position where it does have a lot of U.S. Assets to deploy, right? So a lot of it sells good to other countries. A lot of those goods are being sold in the US, so it gets paid in US dollars for the most part, so it has to reinvest that money somehow. So I think China does have a bit of a different incentive here than Canada would have, but that's typically how it is. But if you Google or put sovereign wealth fund, they don't really differentiate technically. I mean, even you'd see people qualify even something like CPP or
Right.
Caisse de dépôt de placement du Québec, which manages QPP. Technically, they'll kind of place them still as a sovereign wealth fund.
These things just become like zombie funds, though. Like CPP is like notoriously bad at like beating the market, and it costs them a lot of money to do that. And I know you work in like the pension space, so
Mm-hmm.
you've kind of like rebutted my like the comment I just made, like I think very gracefully in the past. But like like it's kind of like Warren Buffett, right? Like in order to make investments of like that size, you have to like it's very hard to find big wins. But like couldn't they just invest in the S&P and just like call it a day and
Well,
not
they can't just invest in equities, right? So they have to have some fixed income because they can't
right,
they can't have all their assets in something that's very
growth
volatile
only, right?
where they have liabilities that are being paid right now but into the future. So you
Got it.
have to, when it comes to pension funds, you always have to balance kind of the current liability growth but also stability and able to pay those obligations down the line. So just to keep things relatively simple, that's how it works. um, La Caisse de dépôt de placement du Québec, that one is really interesting because CPP is meant to get the best, they're really trying to achieve the best possible returns. Where in Quebec, what they're doing is kind of a dual mandate. They want to achieve the best possible returns while also supporting the Quebec economy. So
Right.
that one is a little bit different. Could be a study case to see maybe how this fund might be, although it's not a pension fund, so it's kind of hard to put them there. But having that mandate to support the economy, and I know they've done some blunders in the past, Caisse de dépôt et placement du Québec, but again, it's that dual mandate that they have as well. So this one's definitely a bit different here. But yeah, pension funds are ultimately, they also have to keep in mind they have like a fiduciary duty towards the members, or in these cases, I guess the citizens or
Yeah.
constituents that paid into those funds.
Interesting. Okay. What else do we have on the docket that we were going to talk about? I know we
Well,
wrap up around
the
1:30
Bank of
here. So,
Canada, I
oh yeah,
thought, someone being in real estate, you
yeah.
already forgot about that.
I put in a video on it,
Yeah.
and yeah, I mean, like, look,
Yeah, I want to hear what
I
you think about that one.
well, like, look, I don't think they're gonna. They can't be in a hurry to cut into an inflationary environment. So I mean, very similar to the trade war. They're just gonna keep waiting and seeing. I mean, it was like I track the like appearance of a certain number of words in the past monetary policy reports, because they put out a monetary policy report yesterday
Yeah.
as well, right?
Yeah, I did it. Yeah.
So uncertainty. We're at like first trade war monetary policy. We're at COVID levels of like the number of uncertainties in the report. So like I mean, COVID, it was very clear like that this was a deflationary outcome, and they were in a hurry to say, okay, we're going to respond to that with cuts. This is like, we don't know. Oil price shock. I mean, tariffs they originally didn't know. Is this going to be
Yeah.
deflationary on? Are we going to lose a bunch of jobs, or are we going to see those costs get absorbed by the consumer and it becomes inflationary? And not that monetary policy can do anything about that with oil prices either. But they certainly can help not exacerbate it by cutting and adding more stimulus to the economy. So I think they're just going to keep waiting until we have some material economic data, and you probably need like what, 3 months. We had GDP print this morning or yesterday, I can't remember, but and it was mildly positive in like I think it was like 0.02 or zero point 0.2, so mildly positive in Feb. So it looks like we probably will not have a recession in Q1. Because we had Q5 or
Mhm.
Q4 was down. So now we've been what if you look at the last
We
five
we flirted
quarters,
with the recession. Yeah.
yeah, it's been like up down up down up down or up down up down up. So I mean, had two quarters in the last year, but they weren't consecutive. Um, I think it really depends. The whole thing really depends on how this oil price shock moves through the
Mhm.
economy. Historically, and we talked about this a lot on last week. Historically, more likely to cause uh, i- fast spike in inflation, demand destruction, recession. But I think their concern is the consumer and the market, and probably disparity in the market has made the economy appear, at least in the last little bit, more resilient to inflationary spikes than the past. And so, could this end up pushing through further into a 6 months or a year of sticky inflation? Like their forecasts are that inflation is going to be in the threes until the end of
Yeah.
the year, and come
Yeah.
down early next year. So like you're not really like in a race to cut into that environment unless you get some really bad prints on GDP, unemployment, like unless you basically have to walk out and be like, all right, here we go, we're going to pull the alarm, we're going to do the thing for you
Mm.
to try and rescue the consumer. So I would say I don't think there's upside in rates. I don't think there's downside in rates in the foreseeable future. Probably more likely to see downside than upside, even though the bond market's kind of pricing the opposite. But I think they're not going to make a move until we have a more clear data points. To tell
Yeah.
you the truth.
Yeah, I think so. I mean, I listened to it. To me, the base case is that rates just stay unchanged. But then they did mention, he said, like, I think word for word, oil prices stay higher than expected and creates broad
Mm-hmm.
inflation pressure. Then that could see them increase rates. Third, I mean, things change on the trade front. So the economy really slows more than expected, then that could lead them to do some rate cuts. And then I guess the fourth and fifth scenario, those are the ones that he was asked during the press conference. I don't know if you saw that, but essentially, um, there are some tougher scenario where negotiations take a turn for the worse and oil stays higher for longer.
Yeah.
And when he was asked that, you could tell he was just like a fish out of water.
Well,
He
like that's it.
basically, yeah, he
It's
said
hard for
like
them to come out and say the word stagflation, right? So that's
you
probably
know,
why, like,
oh,
you
they
don't
were,
want you
it
don't want
was
to sound the
uncomfortable.
alarms. Yeah.
Yeah,
Yeah.
I
You don't want
mean,
to sound the alarms.
some of the questions asked there are pretty stupid, but some once in a while you get a good one, and that one you could tell, you could almost tell though that it's like a fear. Like you could tell his answer was like, "Well, if it gets to that, we'll deal with it, but also we don't know how we'll deal with
Right.
it," because that is, yeah, the
Yeah.
worst case scenario. Because then, yeah, exactly, you're seeing the economy slow down and potentially inflation stay higher and longer. So they're
Yeah.
kind of screwed and stuck between a rock and a hard place.
Yeah. Yeah, I mean, that like pure stagflation would be like one of the worst outcomes possible, right?
Mhm.
But like, there's no, I don't think there's a worse setup for a central bank. I think, like, I guess the question becomes, like, with record deficits and all this, like, government spending, like, is fiscal dominance also at play here a little bit, where they can only do so much to cool the economy when the Fed's spending record amount of money on, on projects and growing the economy. And
Mhm.
I guess the other thing
And
is,
maybe just to clarify, fiscal dominance is when the central bank is essentially forced to react because the government is spending
yeah,
so much, right? Like they
yeah,
don't, they're not truly independent because they're at the mercy of what the government is doing in terms of fiscal spending.
yeah, or basically, like, they're not in the driver's seat because
Yeah.
fiscal policy rather than monetary policy is
Mhm.
providing more stimulation to the economy, positively or negatively, which seems to be the case for the last little bit anyway. I guess then it kind of like leads me to the Fed, right? So
Yeah.
um,
that
it
was uh that was
yeah,
an interesting one.
yeah. So what's going on there, and like what is you know most people are of the perspective that Canada can't really cut until the Fed does. I don't know if that dynamic changes at all as a result of like petrodollar versus imported inflation, but and what your read is on that. But I mean, assuming that that's the case, like what are we looking at from the Fed, and then does that give Canada room to follow, or are we sort of like in a position where we are kind of in trouble because we don't have as much room, but we have a consumer that's way more indebted, and so we're actually far more sensitive to these high
Mhm.
rates than the U.S. economy, and they don't have to be in as much of a hurry as us. Sorry, I asked you like 10
Well,
questions there, but
yeah,
I
no,
think you get
well,
where I'm
I'm
at.
gonna start off like, did you have a look at the CME Fed Watch tool?
Yeah,
It's pretty wild how it's changed since
I
their
know. Yeah,
Fed
I think it's the
announcement.
most volatile I've seen it. Honestly, I feel like
Yeah,
it changes. Yeah,
yeah, because I think I looked at it was for last week, and it was basically 50-50 chance that we would just like have a cut versus no cut, just stand
yeah,
pat by the end of the year. And now you're looking at like 50% chance into September of 2027
yeah.
that we're at the current rate. So 18 months from now, roughly. You're also looking. Let's stick at the 18 months. So you're also looking at 18% chance. Actually, let's say 20% chance of an increase, and then about 25% chance of a
Crazy.
rate cut, which is pretty crazy. I thought it was really interesting just how big of a shift it was. So those rates are looking like, at least the market's pricing in like those rates are going to stay higher for longer.
So, is like, do you think that that Trump is trying to game the yield curve like with war and like trade war and stuff like that, and was trying to like push them to get rates lower, or like, do you like what's your read on like what are they doing and why?
I don't know.
Like, or does he not understand the economy like exceptionally well and like the mechanics of like how some of these things are and how they're moving into rates? Like, because he'll like I think he'll do something and then the results like the results that probably should have been obvious prior materialize, and he's like not happy with it. Like he expected a different outcome, right?
Yeah, I mean it's really hard to know what Trump thinks. I don't think I really look. This is just my opinion, but I really think they thought Iran would be over
Done.
within
You
like a
actually
week or
think he
two.
thought that like that would
Yeah,
be really
yeah.
interesting?
I think they thought it would be extremely quick. I think he, the perception I get, and from some of the people I've been reading that are pretty connected, trying to get some independent stuff as well, is that I think they were surprised how well it went for Venezuela and thought they could achieve
Right.
potentially something similar, and as quickly, and how important Iran is, but also in the grand scheme of things, when they're also trying to establish who, you know, the the power structure with China going forward, right? So
Yeah.
it's clear that Iran has a role into that as well. I really don't think they thought we'd still be here. What, 2 months now it's been?
Yeah,
And
you like that. It just feels like very foolish to feel that, like to believe that. No, like the like it like history would tell us that. I mean, I guess it's just like a fallacy of presidents that they like historically are overestimate their capability at doing
well,
war. But
egos,
like,
right? Yeah.
yeah,
So like, I think egos plays a big part. I mean, like, I play poker every now and then, and I do pretty well. And you'll see incredibly smart people that you think they should do better, but it's just they can't separate their ego
yeah,
from logic. It just, the
yeah,
ego takes over, and I don't think Trump is any different. I mean, it's not just Trump. I think a whole lot of politicians, they prioritize their legacy, and they kind of zone in on one thing. I think for him, it was probably to be the president who took care of the Iran question or the Iran problem, and then wasn't really thinking about the potential outcomes of the war and what it could have on bond markets, what it could have on
right.
inflation. I mean,
Isn't that
uh,
like their job to like evaluate all of that stuff, like second order effects? Like it feels like I look like I would do that on my investments,
yeah,
maybe, right? Like, but I feel
but
like I'm always now thinking about like second order effects because like the
okay,
best deals are made there. Like you don't, or isn't it these people's jobs to like really evaluate that stuff?
okay. Well, question for you: do you think when he has all his advisors in one room, do you think the advisors are telling him what he wants to hear or
Right.
what he needs to hear?
That's a good question. Like, I mean, it's tough to say because you think about this with the guys like Elon, like as well, like or like any like American kind of like very successful business person. It's like, does it serve you to surround yourself with yes men? But I don't know. I would guess based on the composition of the administration or cabinet or whatever you call it, that
Mhm.
it's probably the that people are telling him that what he wants to hear. But that like that is that I guess that just leads to the outcome that we're in now, right? So okay,
Yeah,
that's fair. That makes like that tracks. I feel like it's a plausible
it's
explanation for why things are the way they are.
yeah. I mean, I think, and I mean, you see this in organizations all the time. I always get fascinated with like sports management and all different like teams
Hmm.
in the same league, and how differently they'll do things. And then you hear things about certain teams being kind of an open box, not open box, but like a place where they encourage different ideas. They encourage being questioned on their ideas, and those teams tend to do pretty well. And then you hear of other teams that you hear of scouts or assistant general managers, other people in the organization, and you hear usually down the line, not a few years after, but you hear that people were just not there to provide different opinions, or they didn't feel safe to provide different opinions. And whatever you think about Trump, I don't know. He doesn't give me all the fuzzy and lovey feelings in terms of that I'll be safe if I give an opinion that goes
Right.
against what he wants to hear.
Well, yeah, he likes firing people for sure. I mean, literally had his line is "you're fired," right? So,
Yeah,
like,
that.
yeah, okay, yeah, it
But
tracks, fair.
yeah, and
Um,
but to get back to the Feds, so I thought what was really interesting. So I'm sure you saw that too. The
yeah,
dissidents, or yeah, dissents. There you go. I was looking for the word. So the dissent. So the last time there was 4 dissents was back in 1992. So it's been quite some time, and one of them was for a rate cut. But it was interesting that the other ones were because they thought the language was too dovish, was leaning too dovish, and they
right,
dissented not because they disagree about keeping rates unchanged, but because they thought that dovish language should be removed. And it was also interesting that even though Warsh may be pushing for a cut, and we don't know, a lot of people assume because he's been selected, it's yeah, I think he's going through the process, not confirmed just yet, but he's been handpicked by Trump that he'll want to cut. But what we're seeing with Fed chairs is they tend to also care a whole lot about their legacy. So he
right.
probably also doesn't want to be perceived as
Like
the guy
Vockler,
who.
but I feel like Vockler's like the most well-known like legacy.
No, but
You know,
there's that point. There is the
yeah,
inflation legacy, but do you also want to be perceived as the last, as the like guy that came after Powell that essentially made the Fed less independent?
right. Like,
So
look, man, I've been saying
yeah,
for a long time with the current brand of politician, like, um, Trump didn't even really start this. Like, I think he did a little bit in like COVID, but like this is the bigger part is like this isn't just a Trump thing. Like, it's
no,
not even a partisan, um, like comment. Like there's t- how many Canadian politicians, federal, provincial, etc., have open like I mean, Carney's actually does it the least, obviously, probably because he's a
he's been
former
there.
central banker and he
Yeah,
respects the independence and understands the importance of that line. I mean, and he probably just knows that he can just like rather than just yelling at Fed chairs or whatever, a Bank of Canada governor, he can just exercise fiscal dominance by spending more and be in control. He's the central banker again if he wants, right? Like,
yeah.
you know,
But also,
or more.
how easy would that be for the opposition to pounce on if he starts
But they haven't
criticizing?
like I mean
Yeah,
think about and nobody's done it, nobody's really done it to Trump, like because I think that the idea of central bank independence is like a hard thing to like it's a hard thing to brand and communicate to your average voter and
mm,
consumer. And if you have to explain it properly, then it starts to like really lean into like, oh, let's explain, financial systems. And then people are like, this is a little weird. Like, are we sure we like this? Maybe we actually want them to not, and I, I just, anyway, all this to say, like in Canada, like, I think both Pierre did, yeah, Pierre, I mean, Pierre said would fire Tiff, right? Trudeau was writing open letters saying that rates needed to come down. Doug Ford was doing the same thing. Eby, blah, blah, blah. Like all these politicians who have no right, who shouldn't even be like communicating, especially not in a public forum in that way, to the central bank. And it's not to say like whether or not it's going to be effective, because it obviously is not at all. It's more just like you're literally putting in public the purposes of populism
mm,
that you are disrespectful of what I would say is one of the most fundamental tenets of capitalism, right? So
yeah. But
I
most
just think
people
it's
don't
weird.
see that. I don't think it's weird actually. I think it's a no brainer for politicians, because
Fair,
if
okay.
they criticize and they say, oh, like you should be cutting rates, and then the central bank doesn't cut rates, they can go back to their constituency and say, look, if
I
I would
tried.
have
Here's the
been,
letter.
yeah, I
Yeah.
tried, and if I would have been at the head of the Bank of Canada Federal Reserves, I would have cut rates, things would
Right.
have been better, and blah blah blah. But then on the other
Hmm.
end, if you're the central banker, you're kind of doomed if you do, doomed if you don't. Because if you do go ahead and you kind of listen, but you say you're doing it for your own reasons, and then it backfires, the politician won't say like, "Oh, well, I was pushing him to cut rates." They'll just say, "Well, they should have seen this happen. Like, they're the experts. Like, they cut rates and they created this crisis, like whatever it may be." So, if you're a politician, you really have nothing to lose, even if
Right.
even if they actually listen to you and you do it, because who takes the blame in the end? It's going to be the central banker. It's never going to be the politician.
Yeah. No, it's a good point. Okay, you've successfully convinced me that their logic like really checks out. So,
I mean,
yeah,
to me, there's just no downside of doing it, right? If they
yeah,
want to be reelected, it's
yeah,
just, yeah, it's super easy to just, yeah, to blame the central banker one way or another. And then, yeah, you take the high road either way.
yeah. Fascinating, man. So what do you think happens now then? Like, Fed stays kind of where they are, BOC stays where they are. Like, it's just basically it's just wait and see, right? How quickly is the oil price spike going to kill the economy? But like, I think Tiff's commentary, at least in the monetary policy report and in the presser, feels like his concern is more that the economy will actually be more capable of absorbing this inflationary shock than like when I showed you that oil price spike chart,
Yeah.
right?
Hmm.
And it's like spike, blow off, recession, right? Like,
Yeah.
20 iterations of it since like the 1950s. Makes sense. But like, it seems like him and even with the Fed, they're actually concerned that the populace might actually be better at absorbing these shocks, as they've proven in the last little bit. They'll like pile on debt or whatever to get by, and
Hmm.
then it actually just, the prices of everything just go up and it keeps getting pushed through, and now we're in like the second round of inflation.
Yeah, I mean, I think they just want to wait and see, right? I think
Yeah.
they're probably trying to see if it's gonna go one way or another, and then they'll act. I mean, if it kind of stays in the middle, then they'll probably just, yeah, they'll stay in path until they have clear data, and then they can just justify their action or inaction based on the data or lack of data that they saw. So I think that's probably where they're going to go. The most fascinating question though is if prices really spike, um, to what point is demand for oil inelastic? I think that's the best question to ask, because it is inelastic to some point, but
Hmm.
it has a limit,
Yeah.
and I just don't know, is it 150, 160? Like, what is it where
Yeah.
you really start seeing demand and people looking for alternatives?
Well, I think that the hard part is it's not so much the elasticity, it's more like the margin compression on the businesses that are
Mm-hmm.
using it as an input, I think,
Yeah,
right?
no, that's
Like
fair. Yeah.
it's like second order. So yeah, like if you look at inelastic goods like food and fuel are probably going to be there, right? Like maybe I'll switch to like I'll just eat like crappier food and craft
Mm.
dinner or whatever for the short term to get by because I can't afford all the stuff that's more expensive. But
Or
and
drive less a little bit,
drive
or take
less or yeah,
public transportation,
yeah,
or
or
yeah,
get a cheaper car or whatever.
yeah.
But it's, what about like durable goods and home building and like other, like it's not concrete and like all of these other things, that not just food and fuel, where now they're like, okay, well, our margin, either we're absorbing the cost and our margins just shrank by
Mm.
whatever 5%, or the consumers absorbing the costs and our orders just shrank by 5% because people aren't going to want to absorb the price, and they're just going to cancel the project or whatever because the numbers don't make sense anymore. That's, I think, the economic contraction can happen in both
Yeah.
consumption and business environment, which is probably of greater concern, right?
Well, yeah, definitely. If you're thinking about just natural resources, right? The extraction, it's super energy intensive. So at some point, you're going to have like something's got to give. Either you get margin compression, like you just said, or they increase their prices, or probably the reality will be a combination of both. And that could still, though, lead into potentially some layoffs for companies that are trying to cut costs to offset that, because maybe they don't have a whole lot of pricing power and they have to cut their costs in some ways. So there are definitely some second order effects, that not just not just projects being put on hold, but potentially just companies too that have to lay off people just to make the economics work because they can't pass the entirety of those costs to other businesses or customers.
Yeah. Yeah. Okay. Maybe we'll leave it there. I
Mm-hmm.
think, right? We've been 55 minutes, almost an hour, and we'll yeah. Anything you wanted to wrap up with, or things that we'll talk about? I think we got Braden for next week for the AI thing. Maybe
I
I'll
think
confirm it on
so.
that, but
Yeah, we'll double check. But if not, I mean, I feel like there's a whole lot of different news that come up every week. But no, this was fun. I mean, the real acquisition of Remax, and talked about it and hadn't really dove into it, so it was fun to look at that in more detail, do some research yesterday and this morning on that, and then obviously the two central banks and the Canada's first sovereign wealth fund. Yeah.
there you go. Cool. All right. Well, yeah, we'll chat. I think next week we're going to try and cover AI if Braden's available. If not, we'll probably just keep going deep on macro. But I'm curious to hear Braden's take. I mean, obviously, as somebody in bed, I have my own thoughts, and we'll talk a little
Mm-hmm.
bit about it. But I'm curious. So yeah, so stay tuned for that one. Make sure you hit all the buttons, like, subscribe, all that stuff, and check out our lives if you're a listener. This is gonna be the first one that actually goes out on the pod feed, but these are gonna be live Friday lunch hour basically. So like
Yeah.
nobody's in the office anyway on Fridays, so just
No,
tune
exactly.
in noon. I think we get we get 200 plus on Twitter, but we're gonna be on YouTube and or X I guess it is
Yeah.
on YouTube.
Yeah.
And next week I got it all figured out. I know how to plug in properly to the
Mm-hmm.
Instagrams and TikToks of the world now. So I think we'll get
And we'll try to schedule them so it kind of pops up and people can actually have reminders on.
yeah.
There's a way to do it. So I've done it before, so I'll show you, Dan, even though you're better than me with most social media stuff.
Yeah. No, amazing. Okay. Awesome. Well,
Okay,
thanks. Have a
thanks
great
everyone.
weekend, man.
Yeah.
Take care.